It depends on what they need. So when somebody brings me a deal, I always, start asking some hard questions, but there it helps build the partnership is, what are you good at? What are you going to bring to the table? What are you missing? So, if you've got a good deal, good. You got that, you brought that to the table, you got a deal. Are you going to be able to bring any of the equity? Yes or no? Do you have any experience in asset management? Do you have any experience in construction and CapEx? And kind of just build from there and then see where I can fill those gaps.
But George, I'm so impressed, man, by what you've been able to accomplish in a very short amount of time. We've spent some time together. I think you're doing it the right way. You have a construction background, and now you are kind of, really kind of leading the charge in multifamily syndication, over 2,000 units. Tell us a little bit about what Elevate, kind of the focus of Elevate right now. And then we're talking about joint ventures today. And so I know you've had a lot of success through joint ventures. And so I kind of want to break that down for our audience. But talk a little bit about yourself and Elevate.
Yeah, so I mean, look, we're in growth mode. I'm really looking to build something massive, and one way I've found to quickly scale and do that is through partnerships and joint ventures. Um, Internally, we're always looking for deals and we're filling our pipeline. But at the same time, I also have joint ventures going on where I have other individuals bringing me deals. And so I've got those two source of pipelines, which is what's leading to, we'll, at the end of this month, we'll be a little bit over 3,000 units.
Wow. Okay, I got to stop saying 2,000, man. I'm sitting here saying 2,000, and in George is at 3,000.
We're also working on selling over 1,400 units. So time to get really aggressive because I'm gonna have to get that count back up.
Yeah, yeah. So, all multifamily, right? That, like, what are the type of deals you're looking for?
Yeah, that's all multifamily. It's all B and C class, true workforce housing for the most part. Some of our B classes maybe a little bit higher than your traditional workforce housing, but true value add. Like you mentioned, the construction company. We really like to leverage that and come in and just kill it on the capex portion of it. We've got one that we just closed at the end of February, so that's been 3 months or so. We're already hitting past projections. We're almost complete with our $1 million capex. Like a lot of that is only done because we have the construction company and we put the work in on the front end, and just once we close on it, we're taking off. 100 plus units is where I like to stay. Even over 150 is ideal.
So tell me this, how does it work for you, since you have the GC side of things, right? The contracting side of things, and then you have your own operation where you're finding your own deals. Like, talk to us about how this joint venture thing works. Like, if someone was to bring you a deal, right, and maybe they're the lead sponsor on it, how does that joint venture work?
It depends on what they need. So when somebody brings me a deal, I always, start asking some hard questions, but there it helps build the partnership is, what are you good at? What are you going to bring to the table? What are you missing? So, if you've got a good deal, good. You got that, you brought that to the table, you got a deal. Are you going to be able to bring any of the equity? Yes or no? Do you have any experience in asset management? Do you have any experience in construction and CapEx? And kind of just build from there and then see where I can fill those gaps.
So give us a real life example. Like, talk to us about one of these recent projects, what that joint venture partnership looked like, how you guys broke it down. And even before you got on here, we talked about kind of equity carve outs and what different things look like in terms of how much each role was worth. Would you give us an example of kind of how one of these recent deals have maybe played out, and what that was, how you guys decided to carve that out?
Yeah, I can. I may not get to every little detail, but in general, so I'll kind of stick with that same example deal that we closed back in February. A group brought it to me. They needed help with the equity. They needed help signing on the loan sponsor. They needed help with asset management. So they pretty much had the deal, and that was about it.
So they had a good deal, and then they
Yeah.
say, "Hey, guys, this is so brilliant. That's what I tell you: deal finding, sourcing good opportunities, and then raising money. It's the fastest way to get in the deal." So a team or group found a good deal, knew George, and then came to you. Okay, what happened next?
So at that point, we start carving up the GP and seeing, what's fair. It's all somewhat negotiable depending, but I mean, for the most part, signing on the loan somewhere between 5 and 10%. And then as far as asset management, I think that's one of the larger chunks, and there's a lot within that, but maybe like a 30% carve out, 30% carve out for the equity. So you're about what, 70 there. I personally like to put something towards the CapEx as well. I think some individuals might say that's part of the asset management. I don't know. I know some that have experience with asset management but don't have experience bringing a $3
Yes, a
million
big piece,
CapEx.
100%. Yeah.
Trying to think of what else we break. Earnest money gets broken up.
Yeah. Okay. So the earnest money, do you keep that? Is the earnest money staying in the deal?
It depends. Negotiable as well. If it's staying in the deal, then obviously you'll also get the LP part for
LP
that.
share, right? Yeah.
Yeah, those shares. And you may get a little more the GP if you're keeping it in the deal as well, taking that into account. As far as the earnest money, that breaking that up just depends. And I've seen anywhere from a couple points to maybe 5% or so, depending what they're doing. So kind of break that up right in the front, right? Make sure everybody understands what they're getting, what their role is. If everybody's on the same page, then we get at it.
I love that. And because once it's clear, so let's talk about this. So that's exactly kind of what we shared before too, guys. That structure is exactly what George was just explaining there. By the way, if you don't know some of these terms, Google them. Earnest money is, again, the money that you need to put up, kind of in escrow in order to close the deal. What he was saying is that, I asked, does that money stay in? If it does, that actually can translate to an LP or limited partner share in the deal. So you get your money's invested into the deal as a limited partner, and you're getting a couple points from on the GP or the GP equity side for putting that earnest money down.
One thing on that, since we're on that topic, I would also make sure to discuss what happens if that deal doesn't close. Who's responsible for that earnest money? Are you going to split it between all the partners, or is that individual that's putting it up knows he's taking all the risk and he's putting it up? In that case, he probably deserves maybe a larger GP for doing that. So make sure you talk about that, so you don't get to the point where you don't close a deal and everybody's kind of looking at each other like, okay, well, what happens with that money?
That's so what you're saying is if you get to a point in the due diligence period where that money goes hard, or you can no longer get that money back, what happens if you don't close the deal?
Yep. It's not fun to talk about, but it's, get it out.
And the other thing, George, have you ever got to a situation where you had to put up more money in earnest money, and then you had to pull equity from another place in order to give more equity for putting up more earnest money?
So adjusting the percentages, you're saying, from the
Right.
GP?
Right.
Yeah, I mean, there's been times where that's had to happen for different reasons. Earnest money could be one. Maybe bringing in somebody stronger on the loan side for some reason. But yeah, it has happened.
So let me ask you this, because I mean, you have a lot of the operational experience. Is why I look forward to partnering with you and stuff. But let me ask you this: in terms of when you get into the deal, so I love the breakdown. I hope that's helpful, seeing how you can kind of carve this out, guys. find good deals, find investors. There's so many ways to grow and scale this, but in the deal, kind of as you're operating, you're doing this, how do you work through, especially let's say you weren't the one who originally found the deal, right? Or maybe it's not a home market for you. Like in terms of decision making and operations post close, how have you, like, what have been things that really have worked well, and maybe things that like you would advise, hey, I'm going to do, like, what's happened, man, I'm going to do it differently next time. What would you say? Like, what advice would you give to kind of post close in a joint venture partnership, how to make sure that stays healthy and the deal ultimately stays healthy for investors?
This doesn't happen very often, but my daughter is standing right here, distracting me so much.
Bring her on.
Huh?
Bring her on. This is a live webinar. This is why we do this. Look at this. Beautiful. What's your name, sweetie?
Ava.
Ava?
Mhm.
Are you going to be a real estate investor one day?
I don't know.
Yeah. Okay. All right. Go see mom. Okay. Sorry about that, man.
No, that's awesome. That's great. That's definitely going on YouTube for sure. So,
So
all
I
right.
know
So
about
post close
operations.
operations, being in joint venture partnerships, keeping the deal healthy, keeping the even the partnership healthy. Since you've done this a lot, advice you'd give for our listeners?
It goes back to knowing your responsibilities. Who's going to be in charge of what, who's going to be actually participating in the asset management and the ongoing. There's we could have a joint venture between, let's say, 5 different partners, but only 2 are really going to be doing the asset management and running the day-to-day. If that's the case, we usually set up a separate meeting for all the partners, and then those 2 asset management partners catch up the other partners and let them know what's going on with the actual weekly asset management meetings, and that works really well.
That's great. So again, you have kind of, and this is why I think it's so important, like the for example, the asset management, that's falling on the shoulders of 1, maybe 2 max, of like, hey, they're the decision makers, they're the drivers in this deal when it comes to that. And I imagine the same thing is true on the investor relations side as well.
Correct. And this is, from experience and from learning. So I've also seen it where it kind of backfires. Well, this doesn't backfire, but the reason for doing it that way is because, let's say you have them all on there on the weekly asset management calls, and everybody's trying to manage the property, right? You've got too many voices coming at
Cooks
you.
in the kitchen, right?
Yeah, man. Cooks in the kitchen. You've got this property management company that's like, who am I supposed to listen to? What is happening? So I've been through that, and that's where we've made our adjustments. Where we're going to put the people in the seat that have the most experience, and that's their strength, and they're going to run with it. And the others are going to, there's maybe somebody that's going to be in charge of investor relations, and they put together the summaries and make sure that we sent the updates out on time and whatnot.
That's excellent.